Swayam Prabha. Digital India. Educated India.
Okay. So, we have been talking about valuation. Um we started with introduction of valuation, and then we started with the comparables uh, techniques in valuation, and in that we will now talk about income approach to valuation. In between, we have understood the DCF technique that will be useful in our these subsequent valuation methods. All of this we are studying as part of the course Real Estate Finance and Investment Strategies. So, first the learning objectives of today's session. So, understand fundamental principles of income approach to real estate valuation, apply direct capitalization methods to value income producing properties, calculate and determine appropriate capitalization rates for Indian markets, analyze relationship between cap rates, risk and property values, apply gross rent multiplier method for quick valuations, evaluate income approach application across different property types. Then what is income approach? That is the fundamental question which we will be starting this particular topic with. So, we will try to answer what is income approach. So, let's take this. The income approach is based on a simple but powerful principle. A property is worth the present value of all the future benefits it will generate. This is exactly the same principle used to value stocks, bonds, or any other income producing asset. Now, think about it logically. If you are buying a property as uh, as an investment, what matters most? It's the cash flow that property will generate over time. The income approach captures this by converting that income stream into a current value estimate. Now, there are two main methods within the income approach. We have direct capitalization, which we'll focus on today. Takes 1 year's income and converted it to value using a single rate. This is like taking a snapshot of the property's current earning power. Then there is another, that is discounted cash flow, which we will cover in the next session, which we have actually covered, and we have discussed the method. Then we have this DCF, and DCF we have understood that it's not just a snapshot, but basically we have for different variable periods, we are projecting occupancy rates, and then we are deciding on the final outcome output using a proper full-fledged analysis for different periods. So, in this particular income approach, we will be focusing on direct capitalization. So, today's focus will be our direct capitalization. Now, when to use income approach? So, understanding this, then that when to use income approach is crucial for professional practice. This isn't one size fits all method. It's more powerful in specific situations. So, first it's ideal for income producing properties, right? So, commercial, retail, residential rentals. So, that is the type. So, this seems obvious, but it's important to understand that we are talking about properties where rental income is primary source of value. So, whether it is commercial, retail, residential rental, we are talking about rent income coming through them. A beautiful bungalow in Juhu that someone buys for personal use might not be best valued using income approach, because it is not producing any rent. The purpose is also not rent, but the purpose is living there, enjoying the big bungalow. So, there we will not be using this approach. Second, it's perfect for investment properties. When someone buys a property specifically to generate cash flow, whether it's a pension fund buying a mall or an individual buying a rental apartment, the income approach reflects their decision making process, right? Because there the idea is to go for rent, right? So, that's a valuable when comparable sales data is limited, and many times Indian market, especially for specialized properties or in emerging locations, you might not have enough recent sales to use the sales comparison approach effectively. We have understood sales comparison approach earlier, where we saw that how we can take a proper comparable, compare it with our property, and then we will try to figure out the valuation of our property, because recently this property was sold in some area which is similar to ours. So, after some adjustment we come to the valuation. So, that is one method. So, that is there. So, here where there is less data for comparison. Fourth, it works best for stabilized projects with predictable income. A brand new mall that's still leasing up might not be suitable for direct capitalization, but an established shopping center with long term lease is perfect, right? So, predictable income streams. Looking at the Indian context example, think about, we have Bandra Kurla complex, BKC Mumbai, or we have DLF Cyber City in Gurgaon. These are primarily investment grade properties where buyers focus on rental yields and cap rates. Similarly, established malls like Phoenix Market City or Forum Mall are valued primarily on their income generating capacity. So, the key is matching the valuation method to property's primary purpose and the buyer's motivation. Then we come to direct capitalization formula. So, now the direct capitalization formula, this is arguably the most important formula in real estate valuation. So, let us break it down carefully. The formula is elegantly simple. Property value equals net operating income divided by capitalization rate. But do not let the simplicity, fool you. There is tremendous complexity here in determining the net operating income and the appropriate capitalization rate. Now, let us walk through the example. We have a property generating 50 lakhs per year in net operating income annually. We will learn exactly how to calculate NOI in the next few slides. But for now, understand that this is the property's annual income after all operating expenses, but before debt services and taxes. The cap rate of 8% represents the annual return an investor expects on all cash purchase. So, if someone pays 6.25 crores for this property and it generates 50 lakhs annually, then they are earning an 8% return on the investment in the first year. The calculation gives us 6.25 crores. This means that at current income level and market expectation, this property is worth 6.25 crores. Notice what we really are doing here. We are saying that 50 lakh per year in perpetuity at 8% required return is worth 6.25 crores today, right? This is present value calculation in its simplest form. This formula is used thousands of times daily across India by bank approving loans, by REIT acquiring properties, by individual deciding whether to buy a rental property. It is the foundation of professional real estate analysis. So, a lot of analysis is being done through this simple looking formula which we have just discussed, direct capitalization formula, right? Simple looking, simply net operating income minus divided by capitalization rate. We are getting property value, but being used in so many levels, at so many levels in real estate industry. So, then we move to net operating income calculation. We have seen that NOI is an essential part of our formula. So now we will talk about what is NOI. So now let's go into it, deeply into this NOI operating income calculation, because this is where many errors occur in practice. So NOI is not just rental income minus some expenses. It is precisely defined measure that requires a careful analysis. Let's go through each component systematically. We have potential gross income, right? We have potential gross income is what the property would generate if it were 100% occupied at current market rents. Notice we say market rents, not the contact rents. If a property has below market leases, we might need to adjust, right? Then vacancy and collection loss accounts for the reality that no property maintains 100% occupancy and 100% rent collection. Even the best properties experience tenant turnover, right? Somebody is coming in, somebody is going out, so there is a tenant like that, and some tenants may be late with payment or default entirely. This is typically 3 to 10% depending on property type and market conditions. Other income includes everything beyond base rent. So we have parking fees, right? We have signage revenue, we have antenna leases, and so on. In some properties, this can be substantial. A mall might earn significant income from advertising and events beyond rent. Then operating expenses include all costs necessary to operate the property. This means property taxes, insurance, utilities, maintenance, management fees. It can also be legal and accounting fees, right? It can be marketing costs for leasing and reserve for capital improvements, right? Then another crucial point, NOI excludes some things. What are that? They are debt service, depreciation, and income tax. And what is the reason? Because these are so specific to the owner, not the property. Two different owners might finance the same property differently, but the property's earning capacity remains the same. So, two different investors might have two different ways to finance their property. Somebody might have financed it at some other rate, somebody had financed some other rate, right? So, these cannot be used because property earning will remain same, earning potential will remain same, owner's cost might be different. So, we do not include that in net operating income. Then we go to NOI calculation example. So, here we are taking an example of Pune office building. So, we will see, let's see this. So, working through a detailed example to make these concepts concrete. This is a 50,000 square foot office building in Pune, a typical mid-size commercial property that might, you might have seen it in practice. Starting with the potential gross income, 50,000 square feet times 200 rupees per square feet, right? Times 12 months gives us 1.2 crores annually. This assumes 100% occupancy at current market rent of 200 per square feet per month, which is reasonable for good quality office space. We then subtract vacancy and collection loss of 10%. This might seem high, but remember that office building experience tenant turnover and sometimes unit remain vacant between the leases. Plus some tenant might delay payments, especially during economic stress. This is 10% is within normal market range for office properties. This gives us effective gross income of 1.08 crores. This is what we actually expect to collect. We add other income of 6 lakhs, right? This could be parking fees, signage revenue, or change for additional services. In modern office building, this can be quite substantial. Finally, we subtract operating expenses of 38 lakhs. This includes property taxes, which can be significant in major cities, insurance, common area utilities, securities, housekeeping, maintenance, property management fees, and reserve for capital improvements. Our final NOI is 76 lakhs. This is the annual cash flow the property generates regardless of how it's financed. This is what we use in our capitalization formula. Now, here you can notice we started with 1.2 crores in potential rent, but ended with 76 lakhs in NOI. This illustrates why you can't just multiply rent by cap rate. You need to account for all these adjustments, right? Then we move to types of NOI for valuation, right? So, in professional practice, you will encounter 3 different types of NOI. Knowing which to use is critical for accurate valuation. Current NOI uses the property's actual recent performance, last year's audited financial statements, for example. This works well for stabilized properties operating under normal conditions. If you are valuing a well-managed office building with stable tenancy and market rate leases, current NOI might be perfectly appropriate. However, many properties aren't operating under normal conditions. Maybe there is an unusually high vacancy due to a major tenant moving out, or rents are below market because leases were signed during downturn. In these cases, stabilized NOI makes adjustment to reflect normal market conditions. For example, if a property currently has 25% vacancy, but the market average is 10%, you would adjust the NOI upward to reflect normalized occupancy. Similarly, if leases are significantly below market rates and will be renewed soon, you might adjust the market rents. Pro forma NOI project future performance based on expected change. That is there. This might be appropriate for properties undergoing major improvements, entering new lease negotiations, or operating in rapidly changing markets. Here is the key professional judgment. Most valuation use stabilized NOI because we are trying to determine the property's value under normal operating conditions, not its value based on temporary circumstances. Think of it this way: if you are buying a property for the long term, right, you will care more about its normal earning capacity than its performance during an unusual period. Buyer can address temporary issues, but they would be paying for the property's fundamental income generating potential, right? So, that is there. Then understanding the capitalization rates. The capitalization rates are perhaps the most important critical and misunderstood concept in real estate. So, let us demystify this. So, all its core, a cap rate is simply a ratio. It's property's net operating income divided by its value expressed as percentage. But this simple ratio carries enormous meaning. First, it's a return measure, right? If you buy a property for all cash, the cap rate represents your annual return in the first year. So, an 8% cap rate means you are earning 8% annually on your investment, assuming you paid cash and then property performed as expected. Second, it's a risk measure. Higher cap rates indicate a higher risk, lower cap rate indicates lower risk. A grade A office building in Bandra Kurla complex might trade at 7% cap rate, while a secondary office building in a smaller city might trade at 10%. This difference reflects the perceived risk. The mathematical relationship is crucial. Mathematical relationship is crucial here. Value is equal to NOI divided by cap rate, right? This means cap rates and values move in opposite direction. They move in opposite direction. If cap rate increases, value decreases. If cap rate decreases, value increases. This is fundamental to our understanding of real estate market cycles. Why does this inverse relationship exist? Because when investors demand higher return, higher cap rates, they are willing to pay less for the same income stream. When they are comfortable with lower returns, lower cap rates, they are willing to pay more. This relationship drives massive change in property values during economic uncertainty. Cap rates increase as investors demand higher return for taking real estate risk. During stable periods with low interest rate, cap rates compress as investors accept lower returns. So, that is the basic understanding of capitalization or cap rates. Then, factors which are affecting cap rates. So, understanding what drives cap rate variation is essential for professional valuation work. Cap rates aren't arbitrary, they reflect real market forces and risk assessment. Location is perhaps the most important factor. Prime location in major metros command lower cap rates because they are perceived as less risky. Bandra Kurla complex in Mumbai or Connaught Place in Delhi will have lower cap rates than similar properties in tier 2 cities. Why? Because prime locations have more stable demand, better liquidity and strong long-term growth prospects. Property type risk vary significantly. Grade A office buildings with long-term lease to credit-worthy tenants are considered lower risk, hence lowest cap rates. Retail properties are riskier because they depend on consumer spending and retailer success. Specialized properties like hotels or hospitals have the highest cap rates because they are harder to release if current tenants leave. Market conditions plays a huge role during economic expansion. Cap rates tend to compress as investors become more aggressive. During recession, cap rates expand as investors become more risk averse. The amount of available capital also matters. When lots of money is chasing limited good properties, cap rates compresses. Interest rate have a complex relationship with cap rates. Generally, when interest rates rise, cap rates rise too, because real estate must compete with other investments. But this relationship isn't perfect because real estate also provides inflation protection and other benefits. The key insight for professional practice is that cap rate reflect collective market wisdom about risk and return. They are not just numbers we pick arbitrarily. They emerge from thousands of individual investment decisions. So, we can see that cap rates is something which is coming from judgment about the overall conditions. Now, we have seen in some prime locations, properties are good condition, marquee properties, lower cap rates. Same type of properties in tier 2 cities, higher cap rates. So, higher the risk, you can say, if you want to make a thumb rule kind of understanding, higher the risk, higher the cap rates, and lower the risk, lower is the cap rate. But of course, we have seen that there can be multiple ways to look at it. There are different ways in which we are understanding this, whether in terms of location, property type, market conditions. So, many things are playing up, and the best is that the experience and the understanding of market can inform you about what is the right cap rate. Also, the kind of environment which is there, business environment which is there, whether it is boom period or bust period, that can also impact the cap rates. Then coming to Indian cap rates. So, we have different possibilities. For grade A office, for Mumbai, we can see it is 7.5 to 8.5%. Delhi NCR, it can be 8 to 9%. Chennai it can be 8.5 to 9.5%. So you can see that Mumbai has relatively lesser value in comparison to other, less risk is perceived. And then similarly for grade B office, you can see same trend being reflected, right. So this kind of cap rates which we are looking at, we are seeing that depending on the type of city, we are seeing a variation in market cap rates. But of course, these ratings are not fixed, they are basically just a glimpse of what are mostly followed, but it can be different. Of course, for any specific projects, there has to be a proper study and then decision for the market cap rates has to be made. Then method to determine cap rates, right. So determining the appropriate cap rate is often the most challenging aspect of income approach valuation. There are three primary methods, each with strength and limitations. The market extraction method is generally considered most reliable when sufficient data is available. You analyze the most recent sale of comparable property, determine their NOI at the time of sale and calculate the implied cap rate. This reflects what investors are actually paying for similar properties in current market condition. The good thing about this method is that it captures real market behavior, not theoretical assumption, but actual investment decision. However, it requires access to reliable sales data and accurate NOI information, which can be challenging in some Indian markets. We have seen that opacity of Indian market because of that, because you may say that we can get it from government portals, from registration offices, but the market rate and the registered rate, there is a difference. So the sale at what price it is taking place may not be actual reflection of, the records are not actual reflection of what is the market reality. So there are challenges in Indian market regarding this. Then we have the band of investment method. This captures real estate, market behavior, not theoretical assumptions, but actual investment decisions. However, it requires access to reliable method. We have seen that for cap rate, this market extraction method. For band of investment method, we have to recognize the most properties are purchased with a combination of debt and equity. So it calculates a weighted average of the cost of debt. The cost of debt will be mortgage constant and the required return on equity. This method is particularly useful when you have good data on financing terms and equity return expectations. For this, you can take an example. So if properties typically sell with 65% financing at a 9% mortgage constant and equity investor expect 15% return, you can calculate the overall cap rate, right. This method helps ensure your cap rate is consistent with available financing and equity return requirements. Then we have the built-up method. So built-up method start with the risk-free, typically government bonds, and add a risk premiums to various risk premium because of the various factors: property type risk, location risk, liquidity risk, and management complexity. This is useful when market data is limited, but it requires significant professional judgment in determining appropriate risk premium. So in practice, professional valuers often use multiple methods and reconcile the results, giving more weight to market extraction when reliable data is available. Then we have market extraction example. So we have a comparable sale in Gurgaon, a commercial building that sold for 15 crores. At time of sale, this property was generating for 1.35 crores in annual NOI. Calculation is straightforward. 1.35 divided by E15 equals 0.09 or 9%. But notice the requirement for this method to be reliable. We need several comparable sales, not just one, because individual transaction might reflect unique circumstances. The comparable property need to be truly similar. Same property type, similar location, similar quality and tenant mix. So, all this has to be there. Then we need correct, accurate NOI information, which can be challenging. Sellers don't always disclose detailed financial information, and sometimes NOI figures are manipulated for sale purposes. Professional valuer spends considerable time verifying income and expense data. The sales need to be recent and reflect current market conditions. A transaction from 2 years ago might not be relevant if the market conditions have changed significantly. When these conditions are met, market extraction provides the most reliable cap rates because it reflects actual investor behavior. This is what investors are actually paying for similar properties in the current market. In professional practice, you would typically analyze 3 to 6 comparable sales, calculate cap rates for each and determine a range. You might exclude outliers and focus on the central tendency. This analysis forms the foundation for selecting an appropriate cap rate for your subject property, right? Then we move to cap rate and value relationship. Now, here we can see this inverse relationship between cap rate and property value is fundamental to understanding real estate market and investment decisions. Let me illustrate why this matters, both theoretical understanding and the practical application. Mathematical relationship is precise and powerful. When cap rates increase, value decreases proportionally. When cap rates decreases, value increases proportionally. But the relationship isn't linear. Small changes in cap rates create large change in value. Let's take one example, the example here. A property with 1 crore NOI is worth 12.5 crores at 8% cap rate. When the cap rate increases to 9%, just a 1% point increase, the value drops to 11.1 crore. That's a loss of 1.39 crore or about 11.1%. This demonstrates why cap rate analysis is so critical. A property might be of great investment at one cap rate and a poor investment at a slightly different cap rate. Small difference in cap rate assumption can justify or reject multi-crore investment decisions. This relationship also explains real estate market cycles. During economic expansion, as interest rate fall, and the investor confidence increases, cap rate tends to compress. This drives property values higher, creating wealth for property owners. During economic contraction, and interest rate rise and risk aversion increases, cap rate expands, driving property value lower. For a professional practice, this means you must be extremely careful in cap rate selection. A small error in cap rate can result in massive valuation errors. It also means that understanding macroeconomic trends and their impact on cap rate is essential for successful real estate investment. Then we move to gross rent multiplier, GRM. The gross rent multiplier is a simpler valuation tool that's widely used for quick analysis and preliminary screening. While it's less sophisticated than NOI based methods, it is incredibly useful in practical situations. So, the formula is straightforward. Divide the property price by its annual gross rental income to get the GRM. To value a property, multiply its annual gross rent income by appropriate GRM from its comparable sales. Here we have an example. This shows an apartment building generates 60 lakh in annual rent. If comparable properties have sold with GRM between 8 to 10, and this suggests a value range of 4.8 to 6 crores, GRM is practically very useful for residential income properties because expenses tend to be more standardized and rental income is the primary value driver. It is also valuable for quick screening as you can rapidly assess whether a property is worth detailed analysis or not. So, however, understanding its limitation is also important. GRM completely ignores operating expenses, which can vary significantly between properties. A property with higher maintenance cost might look attractive on a GRM basis, but be unattractive when you consider NOI. GRM also doesn't account for difference in the vacancy rates, right? Lease terms or other income sources. Two properties with the same gross rent might have different value while you consider these factors. In professional practice, GRM is often used for initial screening or rough estimate, but serious valuation requires NOI-based analysis. So, think of GRM as a quick filter to identify properties worth detailed study, not as a substitute for thorough analysis, right? Then we are coming to GRM advantages and limitations. So, advantages are clear. It's a simpler calculation, minimal data requirements are there, quick screening tool, it is widely understood metric, but then there are certain limitations. Ignore operating expenses, doesn't account for expense ratio differences, overlook vacancy rate variations, and less accurate for complex properties, right? So, there are certain advantages and limitations, right? So, we have to understand that the key is using GRM is appropriately when it is required for a quick screening and preliminary analysis, but not for the final investment decision or formal valuation. Then we have RERA impact. RERA has been fundamental in bringing about lot of changes in real estate business in India. So, we have been looking at how RERA is impacting different methods, processes of valuation of different techniques related to real estate investment. Similarly, here also we can see that RERA is impacting income approach. So, we are seeing that there are certain positive changes, improved data transparency and availability. The data is now more transparent, it is available because of the rules and regulations of RERA. We have a standardized area measurement, carpet area has been brought in. Earlier there were multiple ways to look at area, there was built up area, super built up area. So, there was always a confusion and what the particular developer or how the transaction is considering the area, whether it is carpet area which is being considered, whether it is built up area, super built up area. So, there was always this confusion, but now it is uniform, it is carpet area for everyone. So, then reduced regulatory risk are there, more transparency has been brought in, and then better project completion reliability is also there because now everything has to be reported. And then impact on this of RERA on valuation. So, lower risk premiums for compliant properties, risk premiums will go down because properties under RERA are now much more you can say much more transparent, their workings are much more transparent. So, we can have more we can rely on their numbers, more accurate NOI projections we can give now. We have reduced cap rates for RERA compliant developments because of all this, because the risk is going down, and then enhanced market confidence because of all the reasons we have discussed. And these are the RERA led impact on income approach. Then we have commercial office property application. So, here we have to understand that first we have to talk about the lease term, which is typically 3 to 5 years in India. Then we have tenant credit quality, which has to be taken into picture, because some tenants where we have marquee names, because of the tenant credit quality, we can be more we can reduce the risk premium. Then property grade classification, whether the property is grade A, B or C, that also impacts our judgment on this. And then what is the location and accessibility of that office property, that also plays a crucial role. So let's take one example here. This is one Bangalore grade A office, which has a 10,000 square foot area, 85 rupees per square foot monthly rent, 95% occupancy and 30% expense ratio. That generates about 68 lakh in NOI at an 8.5% cap rate, appropriate for this property type and location. The value is approximately 8 crores. Notice how occupancy assumption and expense ratio significantly impact the value. Professional valuers spend considerable time validating these assumptions through market research. So, market research is a crucial element here. Then let's talk about retail property valuation consideration. So, we are talking about some special factors which are playing here. So, percentage rate rent provision are perhaps the most distinctive feature. Many retail leases include both minimum guarantee rent and percentage rent based on tenant sale. So, this creates upside potential for both the landlords, but also add complexity to income projection. So, we need to also understand not just the lease terms, but the sales potential of the retail tenant. Then the distinction between anchor tenants and vanilla retailers is crucial. Anchor tenants, typically large department stores or supermarkets, often pay below market rents, but generate customer traffic that enables higher rent from smaller tenants. Professional retail valuation must consider this ecosystem effect. So, we know that in some malls we have big bazaar, we have in the whole mall there is a west side store. So, many people go to those malls just because of that big mega store which is there. There might be some other type of retailer which is there. So, Big Bazaar was earlier, but now a better example would be the West Side and such type of stores, which might be the very big stores, which might be the anchor stores of the whole mall. People are visiting that mall just mainly to visit that store, so they will pay lower rent in comparison to some other shops in that mall. So, these kind of special factors we have to consider. Then common area maintenance recovery can be substantial in retail properties. Shopping centers have extensive common areas requiring maintenance, security, marketing and management. These costs are typically recovered from tenants through CAM charges, but the recovery isn't always 100% affecting the NOI calculation. Then seasonality adds another layer of complexity. Retail sales vary significantly by seasons, affecting percentage rents and sometimes causing temporary tenant failure. Professional valuers must understand these patterns and their impact on income stability. Now, here we have example of Mumbai Mall, and we can see that the higher cap rate reflect retail market volatility, tenant turnover risk and management complexity, which is clearly evident through this example. Then let's talk about residential rental property analysis. So, here you can see the most striking characteristic of Indian residential rental property is their lower cap rates, typically 2 to 4% compared to 7 to 10% for commercial properties. This isn't because residential properties are less risky, but because Indian residential real estate has historically been driven by capital appreciation expectation rather than rental yields. This is a very crucial point. We should remember that the cap rates here are not reflecting that the retail in any way, the residential real estate is in any way less risky. This is basically showing us that historically the expectations of rental yields have been rather subdued, and mostly we look at it as through the lens of capital appreciation. So, this creates an interesting valuation challenges. Properties that appear expensive on an income basis might be appropriately priced when considering total return expectation including appreciation. However, for pure income focused investors, Indian residential properties often don't meet return requirements. Regulatory considerations add complexity. Many Indian cities have rent control laws or tenant protection regulation that affect rental income potential. Some properties have tenants paying below market rent due to old tenancy laws requiring careful legal analysis. The expense structure for residential real residential properties is typically simpler than commercial properties, but certain costs can be significant. Property taxes vary widely by location, maintenance costs depend heavily on building age and quality, and management can be complex when dealing with individual residential tenants. Here in this example, we can see that the lower cap rates reflect market realities. Residential properties in good location maintain this pricing because buyer expects significant capital appreciation to supplement rental returns. For investors focused purely on current income, these properties might not meet the return requirement. Then moving on to mixed use property case study. So, key principle is recognizing here that retail, office and parking components serve different markets and should be valued using appropriate cap rates for each use. Simply applying one overall cap rate to the entire property would be inappropriate and inaccurate. So, for the retail component, we use 8% cap rate reflecting the prime Andheri East location and 100% occupancy. High street retail in established Mumbai location commands premium valuation due to limited supply and strong demand. The office component use a 9% cap rate, slightly higher than the retail due to current 85% occupancy. Office market can be more volatile than the established retail location and the vacancy factor increases risk. Parking use a 10% cap rate, the highest of the three components. While parking income is often stable, it is also the most vulnerable to change in transportation patterns, office occupancy, alternative parking supply. The component value are 21 crores for retail, 33.15 crore for office and 2.16 crores for parking, totaling 56.31 crores. So, this demonstrates how component analysis can reveal value that might be missed by treating the property as a single use. The methodology is basically using different rates for different type of properties. Then we move to income approach limitations. So, of course, there are limitations, data limitations, right. So, are perhaps the most significant challenge in Indian market. Many property owners maintain informal records, right. There are no proper records which are there. Then we have unregistered agreement might not reflect the true market condition. This make it difficult to establish accurate rental rates and lease term for valuation purposes. Market volatility effect income approach reliability because cap rates can change rapidly during economic cycle. A valuation using today's cap rate might be significantly different from one using cap rate 6 months ago. This particular challenging in emerging markets or during periods of economic uncertainty. The subjective nature of key inputs can lead to valuation variation. Different professional might select different cap rates, make different stabilization adjustments or use different expense assumption. These subjective choices can significantly impact the final value. Limited applicability means income approach isn't appropriate for all properties. Owner occupied properties, special purpose buildings like hospital or schools, and properties in market without rental activity can't be reliably valued using income approach. Professional valuers must address these limitations for a proper good analysis. Then reconciliation with other approaches. So, professional valuation practice rarely relies on a single approach. We have seen that many times. Instead, valuers typically apply multiple approaches and reconcile the result to arrive at a final opinion of value. This reconciliation process is both art and science. So, the three main approaches each capture different aspect of values. Sale comparison, we have seen earlier, reflects what buyers have actually paid for similar properties in recent transaction. Income approach, we have seen now, that reflects the property earning potential. Next, we will see cost approach, which is basically about replacement cost, right? So, for income producing properties, the income approaches typically receive the highest weight because it most closely reflect buyer's motivation. Investor buy these property for cash flow. So, an approach based on income generation is most relevant. However, other approaches provide valuable cross check. If income approaches suggest a value significantly different from recent comparable sale, you need to understand why. Maybe your cap rate is wrong, maybe the comparables aren't truly comparable, or maybe market conditions have changed. The weighting process requires professional judgment based on data quality, property type and market conditions. For a stabilized office building with good rental data and recent comparable sale, you might weigh in income approach as 60% and cost approach at 10%, right? So, the weights can be different. So, sale comparison in that case can be 30%. So, our Delhi example shows this process. These approaches produce values ranging from these approaches produce value ranging from 17.8 to 19.2 crore. Rather than simply averaging these values, the professional reconciliation process consider the reliability and applicability of each approach, right? Then best practices. So, verify all income and expense information. Use multiple data sources. We have seen multiple data sources are very important. Reliability of data can be difficult in India. Then confirming lease term and tenant quality, that is important for commercial properties. Then applying appropriate stabilization adjustments, that we have to make adjustments for our stabilization, and then use market support cap rates, that is there, and then consider property specific risk factors. There are certain risk factor attached to a specific property that we have to also consider, and documentation. So, support all assumptions with market data, explain stabilization adjustments that you have made, and provide sensitivity analysis, that is a bracket of percentage, that if we move plus minus this much, what will be the impact on overall output of our analysis. Then practical application tips. So, office focus on lease terms and tenant credit. For residential, account for regulatory environment. For industrial, evaluate functional utility and market demand. For market analysis, research comparable transactions, understand the local market dynamics, and consider future market trends. Key formula we should remember: value is equal to NOI divided by cap rate. For direct capitalization, NOI calculation should be PGI minus vacancy minus operating expenses plus other income. Market extraction cap rate is equal to NOI divided by sale price. Gross rent multiplier, value is equal to gross annual income into GRM. Industry trend and future outlook: increasing institutional investment in India. Real estate, it is taking place, picking up, and they want more detailed calculation. So, all the assumptions you are making, you should be clearly telling them in that report. Growing importance of ESG in valuation. So, sustainability is also becoming crucial area. that is also impacting valuation. Technology adoption improves data availability. So, awareness of data should be there, because technology upgradation, whether in forms of AI, blockchain, is constantly updating this area. So, you should be aware of that. The REIT market expansion is creating a new benchmark. So, REIT is coming up. They are because of that, new money, new technology, new people are getting interested in real estate market. And then impact of hybrid work on office valuation is your future consideration. E-commerce effect on the retail property values, infrastructure development affecting the cap rates, regulatory changes and their evaluation impact. So, these are some important points which you should remember for your future considerations in this particular area. Then common errors, we have to avoid data errors using gross income instead of NOI. That we have to remember, applying inappropriate cap rates. All these points we have seen earlier, failing to basically stabilize NOI appropriately, ignoring market trends. Professional standards, always verify data sources, document all assumptions and provide range of value when appropriate. So, basically the key takeaways are: income approach, value property based on income generating capacity. Different property types require specialized considerations. Income approach should be reconciled with other valuation methods. Thank you.